Okay, and while I'm doing this, I'm going to share my screen. I'm going to say welcome everyone to Chapter 13. We are so close to being done the tax theory. This is very exciting. So just a quick summary, we're going to be doing student income today and student credits as well. And then all of this is going to be in your slides. You can find it very quickly. We're going to start with the self-test. So we're just going to do a quick refresher of what we've done. Going to do some review problems, and then we're going to jump into the theory for Chapter 13. So let's start with the first one. We have Christina. So I'm going to pull out my polls here as well because we need those. Christina is 66 and widowed. Her only sources of income are CPP and OAS. Can she claim the pension income amount on her tax return? Do those count as the pension income amount? We're going to do a quick poll here. You can tell me yes or no. If you're not sure, remember there's a chart in facts and figures that tells you which things are eligible for the pension income amount and which ones aren't. Okay, 15 seconds, half of the class is answered. Let's try to get everyone on these ones. 5 seconds left. Hit the submit button if you think you have an answer so that it gets registered. Okay, let's see how we did. Remember, you can't split CPP and OAS. And remember, you can split anything that's eligible for the pension income amount. So that should answer the question for you. But let's see how we did. So we got a split class. Half of you said yes and half of you said no. If you said no, you are correct. OAS and CPP, even though we think of them as pension income, and even CPP has the word pension in it, they are not eligible for pension income splitting, and they do not qualify for the pension income amount. So if the only income she has is OAS and CPP, she does not have a pension income amount. Okay? Keep those ideas connected. I normally tell you to keep things separated. Connect what can be split to the pension income amount. If you know that it can't be split, it's also not going to have the pension income amount. All right, let's try the next one. Judith is 67. She received $10,000 in an RPP annuity payment. That's reported in box 16 of a T4A. As soon as you see anything with pension, pull out your facts and figures pension checklist. It's very helpful. She received $5,000 in RCA income, which is reported in box 17 of a T4A RCA. Her spouse is 64 and he doesn't receive any pensions. And then assuming that they elect to split the pension income, what is the maximum amount Winston could claim on line 11600? So what is the maximum that can be split in this scenario? Okay, this was a tricky one. I actually haven't looked ahead on my slides to see. So remember, you're limited to 50% of what is splittable. Okay, let's see how we did. Fewer people tried that one. Remember, you should be doing the self-test in advance, so you don't need to think when you get to this part. You're just going to pop your answer in. Okay, what is the actual answer? It says answer C there. It should say answer D. That's a typo. Okay, but the answer is 7,500, which was D. Okay, and it doesn't matter that he's under 65 because the person who is over 65 is eligible for the RCA, and therefore they're both eligible to split, so it's 7,500 and the correct answer is D. If you're not sure on that, this is one I had to look up. So I did not have the answer off the top of my head because I don't deal with RCA income all the time. That's perfectly fine. I can't do everything on every tax return all the time. I have a lot of information in my head. That's why we have textbooks. So if you look it up, you find out that the RCA is eligible to split, and therefore it's 7,500. Okay. Let's do the next one. John and Zara, they separated on June 15th, 2020. As part of the written separation agreement dated July 1st, 2020, John has to pay Zara $200 a month in child support and $100 in spousal support. He has not missed any support payments this year. So we have a written agreement. There's a child support portion and a spousal support portion. How much can he claim as a deduction on his tax return? And let's try this one. This is not as difficult as the example I gave you when you have a part of the year that there was missed payments. If you are working on the one with missed payments, go back to the class, rewatch the recording, and you can practice the Morticia and Gomez one. But let's see if we can get everyone to get this one correct. In advance of the theory exam, I'm going to say start practicing reading your questions carefully. If they give you a line number, take a look at the T1 and make sure you know which line they're asking about. Okay. 6 people still haven't answered. I'm not seeing any movement, so we're going to go there. How did we do? Everybody who answered, you got it correct. The deductible portion is only the spousal support. The child support is not deductible. If they had asked for the reporting line, it would have been a different amount. But they asked for the deduction line, and so it's 12 times the $100, which is the spousal support portion only. That is the correct answer. Good. All right, next one. Question 4, Rachel and Earl separated in July. Earl was not working when they were together and did not earn any income prior to separation. We just learned the answer to this, but you could read ahead. By a written agreement, Rachel paid monthly spousal support to Earl for a total of $6,000 last year. Is Rachel allowed to claim both the spousal amount and the deduction of spousal support payments? Can she claim both things? This is going to be a yes or a no, so if you haven't come up with the answer, think about what we talked about in class just today and see what you get. And if you're not sure, it's 50-50 chance. All right, half of the people have answered, half of the people have not. Still waiting for a few more people to participate. All right, I'm going to stop it there. Almost everybody got this right. The answer is no. She is not allowed to claim both. She can claim either, but not both. So, especially for those people where English is not your first language, taxes are very grammatically connected to things. You have to be very careful. Is she able to claim either? Yes, she can pick which one she wants, but she can't claim both. And that's why the answer is no. Okay, she has to pick one or the other. She'll pick whichever one is best. All right, and then we have one more. We have Michael and Deborah Boyd. They're married. They have 3 children. Peter, born in 2008, Thomas, born in 2011, and Douglas, born in 2014. During the year, they paid a total of $10,000 to Jack and Jill Daycare. Michael's net income was $40,000 from employment. Deborah's net income was $21,000 from employment. Who is eligible to claim the child care expenses? Michael, Deborah, both, or neither? Okay, and I'm going to open that poll. Okay, if you have an answer, hit the submit button, lock it in. And I think I'm going to stop it there because it looks like the same people are all participating and the same people aren't, so we're not going to spend more time. Everybody pretty much said Deborah, and you are correct. They have children. They have child care that they have paid for to an eligible person. It is to a daycare. They have receipts. They have income from employment. So in this case, Deborah can claim the child care. And Brittany, you pointed out unless there's an exception. Good. That was going to be my next question. What kinds of things would make it possible for Michael to claim the child care? What would have to happen to allow Michael to claim the child care? Come up with some examples in the chat window if you can. If Deborah was in school or in jail or in hospital or incapacitated in some manner for at least 2 weeks. Excellent. Those are the things we're looking for. So that would count. Everything else not. Good. What if Deborah's income was from maternity EI? In that case, what happens? And Helene, I'll answer your question next. But if her income was not from employment, but it was from EI maternity leave, who would claim the child care? We're talking about the 2021 tax year. Still Deborah, because 2021 says income from EI counts as earned income for 2020 and 2021. Good. What if we're talking about the 2019 tax year? We're doing an old return, and her income was only from maternity leave EI. In that case, who would claim the child care? To make it extra tricky. In 2019, EI does not count as earned income, so she would not be able to claim child care, and Michael would not be able to claim child care unless, and there's one exception, unless she's on maternity leave and she has to pay the child care to keep the spot open so she can go back to work when she's off maternity leave. That's the only time EI income would count as earned income. So most people who are on EI any year other than 2020 or 2021 cannot claim child care if they are the lower income. And if they are the lower income and they can't claim it, but there's no Part C exception, it means nobody gets it. Okay. So it's going to look different when you do tax returns than it did when I started doing tax returns, because I got very comfortable with telling people that they can't claim their child care because the lower income person did not have earned income. 2020 and 2021, all of a sudden, lots of people are claiming child care who wouldn't have been able to in most years. It looks like it's going to go back in that direction, and we're all going to have to get comfortable with it again. All right, there we go. That is the self-test. Okay, so the supporting person with the lower net income must claim unless there's a Part C exception. Helene, can it be split? It's only split through a Part C exception. So Part C exception allows it to be split. Okay, and you asked, what if she doesn't need the expenses? Well, it's a deduction, so if she only deducts enough income to get her down to zero, then it's wasted. Okay, so you can't split it unless there's a Part C exception. The advantage of a deduction, however, is that even if she doesn't need a deduction for her return, it does reduce her income. And having lower income means a higher spousal amount and a possible higher spousal transfer. So it can still be beneficial to claim even if it doesn't increase her refund. It might still increase his refund from that perspective. So we do still put child care on, even if their income is low enough that it doesn't affect their tax return. It might affect the spousal amount, and that's beneficial. Okay? But yes, at the end of the day, if she had $2,000 of income and $10,000 of child care, the most benefit she's going to get is a reduction of $2,000 in income and an increase of $2,000 on the spousal amount. So the rest of it would be wasted. All right. Good. So before we go on to the next thing, I want to do some review problems next. I'm going to do the review problems fairly quickly. I'm going to assume that you have done them. You've had extra time to get them ready, and they are tricky, so they are good to practice. If you haven't practiced them, this is going to go quickly. We are recording this. You will be able to rewatch the recording after you've done it. And of course, you can always send me your review problems to look through as well. So let's start with the first one. We have Joshua and Charlotte. Okay, I'm not going to read the case to you this time. Brittany, sorry, going back to the child care, there may be something else you could send his way that child care would be beneficial as well. There's lots of different things. Yep. So we're always looking for reducing income that's going to help with something else. Might increase other things. It might increase an age amount if they're older parents. And sometimes the reality is child care is just wasted. So sometimes you pay for things and you don't get to claim them on your tax return. We all have to get comfortable with that idea to be good tax associates. All right, so I'm not going to read the case to you, but I am going to point out a few things as we go through. So assuming you've read the case, let's go down and answer the questions. Okay, so question number 1, Joshua invested in some stamps. Can he claim the amount of money he spent on the stamps as an investment expense? What do you think? So I'm going to say give me a check mark if you think yes, give me an X if you think no, or let me know in the chat window. Okay. The answer is no, because what did he get? He paid money and he got stamps. So it's going to be an asset that he owns. He will, and you can reassure him, because I have clients come to me with this all the time. I've invested in something. I want a deduction on my tax return. What will happen is when he sells it, he'll be able to deduct the cost against the profits when he sells it. So he will get credit for the fact he bought it. It's just going to be at the other end of things when he finally sells it. So that's the important thing to know. Now, if he spends a whole bunch of money on a fancy humidifier and a safety deposit box and a bunch of other things to keep his stamps in, can he claim any of those expenses? So he's going to put the stamps in a fancy climate-controlled storage locker somewhere. Will any of that count as an investment expense? Nope. He is choosing to protect his asset. That's on him. Especially safety deposit boxes. They used to be eligible as carrying charges. But when I say used to, I mean before I started doing taxes. So they haven't been as long as I've done taxes, and yet somewhere out there, someone has the idea that someone said you can do it. And these ideas stick for a really long time. So the asset itself, he'll get to claim the cost. When he sells it, it will reduce the amount he has to pay on the sale. All right, Charlotte, let's do Charlotte. Same thing, I'm going to clear the notes. Does Charlotte have to report her bingo winnings? If you think yes, she does, give me a green check mark. If you think no, she doesn't, give me a red X. I see a whole bunch of red X's. Bingo winnings, not reportable on a tax return. They are not captured in the Income Tax Act. And Brittany, thank you, unless she gambles for a living. If she's a professional bingo player, I don't think there are professional bingo players, but let's say it was poker. If she's a professional gambler, then yes, but in this case, no. Good. All right. Now, they had a Bank of Nova Scotia account. Just a reminder, they did not contribute equally to it. Should the interest in the Bank of Nova Scotia be split 50-50 because it's a joint account? Okay. If you think the answer is yes, give me a green check mark. If you think the answer is no, give me a red X. Joint accounts are not split based on ownership. They're split based on contributions. So in this case, if you know that 1/5 of the money was Charlotte's and the remainder of the money was Joshua's, then we have to split it in the same contribution. So it'll be an 80-20 split in this case, 80 to Joshua and 20 to Charlotte. Good. Keep an eye out for that. All right. Which medical expenses can be claimed? I'm going to scroll up so you can see the medical expenses. We have a dentist, Dr. Feldman, dentures for Charlotte. We have eyeglasses, and we have $150 to join a health spa. Out of those, dentist, yes, not cosmetic, but in this case it's definitely not cosmetic. Optical, yes. Why not the health spa? His doctor said he had to do it. It is good for his health. If you had to explain to him why, what would you tell him? It's not on the list. Yep. Even if he got a prescription, because they'll say, well, I'll go get a prescription, my doctor will write one, and his doctor probably would write one. It's not on the list. So if it's not on the list, you can't get it. If you don't like the list, call your MP and complain. Very good. Donations, I'm hoping by now you're all comfortable with donations. I'll show you the donations on the tax return. Okay. How will Joshua report his Social Security pension on his tax return? So he has U.S. Social Security. Where will that go on the tax return? I'm looking for 2 places. It's going to put the total income on the pension line. Excellent. Convert to Canadian. Don't forget to convert to Canadian. Very important. And then the exempt portion will come off. Good. And how do we know how much is exempt for his U.S. Social Security? How much will be exempt? 15%. Excellent. If you got that, doing really, really well. And then pension income. When you get to pension income, please remember the U.S. income counts, but you have to take off 15%. And Helene, I'm not sure which half-year rule you mean for the pension. So let me know. And then we're going to talk about non-refundable credits for Joshua. If he received it prior to 2010. Yes, so it's actually prior to, how many years back is it now? So the 50% rule, he would have had to have started collecting it prior to, I think it's, I can't remember the year, but he had to start collecting it prior to that year. He's not old enough to have done that. So in this case, if you look at his age, you know that it's not an option. Yeah, we're really looking at people who are like late 90s into the hundreds to be old enough to have qualified, for U.S. Social Security. And they had to have started getting it and lived in Canada the whole time and never left Canada. So it's really, I mean, I'd be impressed if you met someone where you had to deal with the 50%. Yeah. but it is a good question. All right, I'm going to show you a few things on their tax returns together. So let me find them in my list here. Okay, I'm going to show you their donations because I want to make sure you have the donations. 390 eligible donations. Once we do the split income, you have to calculate the split income correctly to get the right answer here. 75% limits him to $24,000. In any event, he's going to be able to claim $390 worth. The first $200 he gets $30 for. The remaining he gets $55.10 credit for. Total credit will be $85.10. So you can do the donations and gift schedule. Even if you're not 100% sure of this number and you haven't done the whole tax return, you can still get the right answer. Okay, medical I want to show you very quickly. So medical expenses, if we're claiming them on Joshua's, if he's the lower income earner, or if Charlotte is the lowest income earner but she doesn't need a non-refundable credit, which is what happens in this case, we're going to give them here. Total up all of the expenses, reduce them by 3% of his income, and this is going to go on line 33099 because it's him and his spouse. If they had a dependent other than the two of them, maybe they had an adult child that they're supporting, that would go on line 33199. In this case, it's just for him and his spouse. Okay, and I want to talk about the split pension. So when we get to the pension line, I'm going to see if I can find the worksheets for you because I want you to see this. On his pension line, he's going to have foreign pensions, that's the U.S. Social Security, grossed up, so converted to Canadian, 1253.5, and he has a T4A from work, which is a registered pension plan. That's $12,103.50. He also has an RSP annuity. You have to check which group he's in, because if he was in a different group, this would not be eligible for the pension income amount. In this case, it is. So he's going to have a T4 RSP annuity payment of $8,461. Deductions, exempt from tax, is going to be line 25600. That portion is not taxable. That's the 15%. And then if I go down even further, calculating the pension income amount, I'm going to have all of the pension income minus the exempt portion, plus the eligible RSP annuity income. Total available for the pension income amount is $20,376.47. So he's going to get the maximum pension income amount, which is $2,000, and that's the amount that I can split on the pension split. So the T1032, I can split a maximum of $20,376. If I did split the maximum, what would it look like? Well, we're going to have Joshua as the person transferring the money. Charlotte is the person receiving the money. Total that we're eligible is the amount that's eligible for the pension income amount. They were married the entire year, so we don't have to prorate it at all. I can split 50%. I'm going to choose to split 50%, which is $10,188.24. And when I do that, scrolling down onto the next page, I'm also going to split 50% of the tax deducted from those slips. So the tax deducted on those slips was $485. Half of that will go to each of them. And then Charlotte is going to have a return with some refund money on it, and Joshua will have a return with income but less income on it. And then each of them will have to sign. Okay? And in case you were curious about how they did, at the end of the day, if you did not have to do the whole return, but if you did the whole return and you want an answer, Joshua is getting a refund of $740.85. Charlotte is also getting a teeny tiny refund of $16.60, $16.16. Okay. And I want you to also notice that for Charlotte, her income previous to the pension split was only from old age security, where there is no pension income amount for that, and some interest income. And so when we split the pension, we're actually going to then go and give her, which is really nice, a pension income amount as well. So she's going to get an additional $2,000 credit because we split pension income to her that was eligible for the pension income amount. So her $2,000 will be here. She would not have had that credit if we hadn't done the pension split. Okay. Are there any questions about this one? Anything that I didn't go over that you want to see? Okay, and I just want a reminder, one more thing that I did make a note of that you should see, which is when we do the pension split, it's going to change the transfer as well. So pension splits change all kinds of things. We're going to see how much we can transfer from Charlotte to Joshua under the spousal transfer, which is Schedule 2. She gets an age amount and a pension amount, but her income is higher, so she needs to use some of it now because she only has a personal credit that we can take off. So now that she's going to be using some of that, he'll get a smaller spousal transfer than he would have gotten if we hadn't done the pension split. But the overall benefit to the family is worth more, which is why we're doing it. Okay, so we do not expect you ordinarily to come up with a good pension income amount on your own. All right, so let's do the next case. We're going to keep going. Oh, where is my case? Here we go. Let's take a look at Antonio and Robin. Antonio and Robin, in real world, we would get a whole bunch of tax slips and they would not volunteer much information. So we're going to do a represent a client. We're going to take a look at their information there, and we're going to take a look at their tax slips. And when I look at Robin's tax slip, I'm going to make this bigger. I noticed that she took money out of her RSP. What box number do I need to look for? She took money out of an RSP. What box number do I need to look for immediately before I do anything? Box 24. When I look at box 24, I go, oh, this was a spousal RSP. If you take money out of a spousal RSP, what do I have to go looking for now? She took $5,000 out. I've looked for box 24. What do I need to ask next? When did he put the money in? Good. So my next thing that I'm going to do is I'm going to go look for RSP receipts this year because that's the easiest one. And I'm going to find out he puts money in every month. He did it this year, and I'm going to go, how often have you done this? And he says, I always put money in. Then I'm going to go back to Rep a Client, and I'm going to look at his RSP receipts for the last couple of years as well, and I will be able to see he made contributions to the spousal RSP in the previous 2 years as well. Now I have to ask if she's taken money out in the last couple of years. She didn't. This is the first time she's done it. What form do I have to fill out as soon as I see that all of that happened? So I know she took money out of a spousal RSP. I know that he put money into that spousal RSP in the last 3 years. What form am I going to be filling out? Schedule 7 for him for the contributions, but T2205 is the one that I'm looking for. Thank you, Marisa. There we go. Because it's going to change what the income is, I'm not just going to put the income on hers. If I did the download on the computer, and you're going to see this, if I did the download on the computer, even though the computer knows there was a box 24, and the computer knows that you put money in, if we don't identify that it's an early spousal withdrawal, the computer will not do it for you. So it will not happen unless you make it happen. We're going to make it happen on paper today. All right. Now, I've gone in, I'm poking around their RSPs. I can also see that he has repayments he needs to make for the home buyer plan and the lifelong learning plan. So his Schedule 7 is going to be complicated. In real life, I would do that on paper first. I would make a note of what I want it to look like. So I'm going to show you what that would be. The first thing I want to know, how much money did he put in? So for the Schedule 7, I'm going to total up everything he put in. As I'm doing that, I'm going to notice he has regular receipts that he has for me, and he also has another receipt for $6,000. And I'm going to go, oh, you did an extra payment. Why did you do an extra payment? Look at his T4. He has a retiring allowance. So now I have the most complicated Schedule 7 that you're going to have to do for this course for sure. which is I have a retiring allowance to deal with, I have a transfer that I want to do, I have some repayments that I want to do, and then I want to see what his room is. So transfer as much as you can. I have a $6,000 eligible. He did put $6,000 in. I'm going to add $6,000 to his RSP, and I'm going to transfer $6,000. Then I'm going to look and see, did he make enough in the rest of his contributions to cover his repayments? So how much did he make in the rest of his contributions? $700 a month. $700 a month times 12 is more than he needs for the repayments, so I can do those repayments in full. And then anything left over, I need to know what room he has. And how much room does he have? In this case, lots, $48,529. So I know that on his side of things, as long as I'm careful, I'm not going to have an issue. And then we have to deal with the income for her. Okay. So my next question for you, Robin has no income of her own. The only income she's going to have on the return is a T4 RSP, possibly with money on hers, possibly with money on his. I can tell you we're going to attribute it all to him. So she's going to have zero income on her return. Does she need to file a return this year? She'll have a nil return for income, but what will she have on her return if she files? We're transferring the RSP income to his return because of the T2205. But there was tax deducted. Who gets the tax deducted? She gets tax deducted. If she wants the $750, she has to ask for it. She should file a return so she can get the $750. Also, she has to file a return because she has to file a T2205, and you need to file a return to do that. So she must file a return this year, but also she wants to. Otherwise, they're throwing $750 away. They're giving it to the government and letting them keep it. So she needs to file a return so she can get that refunded to her. All right. How much do they each report? Well, we need to see the T2205 to do that. So I'm going to show you my T2205. I go into Robin's return. We're going to have the tax year 2021. She took the money out. She's the annuitant. He's the contributor. She took $5,000 out. He put $7,200 in between this year and the previous 2 years. That's more than $5,000, so all of it is going to go on his return. He is going to report $5,000 as T4 RSP income. She's going to report $0, and that's how the answer is going to go. And then her return, if you want to look at her return, her income will be $0. Everything on the return will be $0, essentially. And then at the very, very end of the return, total income tax deducted $750. She gets $750 refund. Then I go to Antonio and I say to Antonio, let's take a look at your income. And you're going to notice he has a nice RSP income. And that's not from anything he did. It's from what Robin did. What advice are you going to give Robin if her brother needs to borrow money next year? So he needs to borrow money. She took it out of the RSP. She didn't know it was going to do all of this stuff. What advice would you give her for next year if he needs to borrow money again? Take it from somewhere else. Don't touch your RSPs. If she knows she's going to need it again in the future, then Antonio needs to stop putting money in now, and they need to wait 3 years. And then she can take money out of her RSPs and not have penalties. Okay? But as long as he's putting money in, she should not be touching that until she needs to retire, and that's when she's going to take it out. Okay? All right, let's take a look at the Schedule 7 because that's the next really difficult thing in here. So for the Schedule 7, you should have $6,000 from the transfer because he did buy a full RSP for the amount eligible to transfer, plus his own contributions to his plan and his spouse's plan, March to December works out to $13,000. And then January, February is another $1,400. Total contributions $14,400. Okay, but he's not going to get a deduction for all of that because he's going to do a repayment. So the next thing we're going to look for is what will he do for a repayment. He's going to repay the minimum required to the home buyer plan, $1,200, and the minimum required to the lifelong learning plan, which is $2,000. That's going to leave contributions available to deduct at $11,200. In this case, we're going to do the transfer for as much as we can. We're going to transfer $6,000. He can transfer $6,000. And the leftover, which is $5,200, if he has room, we can also deduct that. He does have room, so we're going to be using up $5,200 of that room this year. He'll get to add the transfer and the extra room. His RSP deduction is going to be $11,200. Okay. Now the problem with that is if you looked at his T4 carefully, in addition to a portion eligible to transfer, a box 66, he also had a box 67, which is not eligible to transfer. So his other income was quite high. He had $6,000 from box 66, but he also had $20,000 that was not eligible. So we've added $26,000 to his income. We're going to give him an $11,000 deduction, but we've added $26,000 to his income. And then his wife has added $5,000 because she took money out of her plan while he was still putting it in. Just from this alone, do you think he's going to have a refund, or do you think he's going to owe this year? Okay, he does have some deductions. He has an RSP deduction. That's about it. I'm expecting him to owe. And if you did the whole return, again, you didn't have to, but if you did the whole return, you'd find out he does owe. He doesn't owe a ton. And the only reason he doesn't owe more, he would have owed more, but the only reason he doesn't owe more is because he changed jobs. And when he changed jobs, one of the jobs took off too much CPP and too much EI. So if you did do the returns, but you've gotten bored and you stopped doing your Schedule 8s and your T2204s, you would have missed some. He had a whole bunch of refundable credit because he overpaid CPP and EI. If he hadn't have done that, he would have owed in the 4 digits and not the 3 digits. So you need to warn him if she's going to take the money out again, that's going to affect his tax return. Now, you don't have to warn him about the retiring allowance. That's probably not going to happen again unless he leaves this job as well. And if he does, he won't have worked there for long enough to have built up a huge amount. Okay, but something to remember, it's going to be a different tax year than usual, and he probably wasn't expecting to owe. He probably thought he was getting a refund because he didn't know how this worked on the tax return. So we have to make sure he's ready for it. All right, I think I've answered all the questions for that one. So we're going to go on to the next one, which is Stan McGrath. All right, Stan McGrath, widower with no dependents. He has OAS and CPP, and he has a research grant. All right, for the research grant, what line number will you put the taxable portion on? Going all the way back to Chapter 2. This is a good time to do a quick refresher. 10400 other employment income. Good. How much does he have to put on there? So he had travel expenses related to his research of $816, and then he spent $1,000 to buy a dog. Can he claim the $1,000 cost of buying a dog? No. He didn't have to buy a dog for his research. He just wanted to buy a dog. So generally speaking, pets are not deductible on a tax return, but the $816 is, so we can take the $2,000 grant and deduct $816, and that will be other employment income. Now, he had a treasury bill that matured. How much of the treasury bill will be taxable? He bought it for $96,980. It matured, and he got $100,000. Brittany, the only time you can deduct your pet or any costs related to a pet is if it's a service animal and it's not really a pet. Yep. All right. Yep. But we definitely have people come in with emotional support animals and things like that, which to them are not a pet and are necessary, but they think they can deduct them. Also, I don't know why, but people just think you can deduct everything on a tax return. I spend a lot of time telling people what you can't put on a tax return. That's most of my job. All right, so Treasury bill, we're going to take the total, the face value of it, what he got, the proceeds. We're going to subtract what he bought it for, and that'll give us an interest amount. How much of that will be taxable? So we have an interest amount. Is interest taxed at 50% or 100%? 100%. So this one you have to remember is not capital gains. Even though it was an asset that he bought, it's treated as interest income and not capital gains income. So it's going to be 100% taxable on line 12100. All right, and he holds 2 mortgages and he receives interest. So people are paying him interest. $15,618 and $26,557. Does he have to put that income on his return? Is that reportable income? Absolutely it is. Interest income on line 12100. What's that going to do to his tax return? Generally speaking, what happens if you put a whole bunch of interest income on your tax return? Generally speaking, you're going to owe. Now, he already knew that that was going to happen. He's probably had that in previous years because he made installment payments. So all we have to find out now is, did he make enough installment payments to cover his income for this year? Because maybe he did, maybe he didn't. We would find out when we did the final return. But next year, is he going to have to pay installment payments next year, do you think? Assuming everything looks about the same, he's a little bit of pension income, he's got a bunch of interest income, they're still going to be paying their mortgages, hopefully. Next year, he's going to be paying installment payments again. Now, this client will be comfortable with that. He will know that that's happening. All right, so going down to the questions, what amount can he deduct as research expenses? We've already said it's the amount of the grant minus the $816 only. Does he have to include the mortgage interest? Yes, he does on line 12100. How much of the Treasury bill is taxable? 100% of the interest, which is the proceeds minus the adjusted cost base, or the face value minus the purchase price. Okay. Will he be able to claim the age amount? Well, to find that out, you need to calculate his net income. And it's close. So I'm going to show you his return very quickly. And for this one, you do have to pretty much do the first part of the return to get the answer. So if we do Stan McGrath, and I go in and I take a look at his return, I'm going to do his income. He's going to have other employment income, that's the research, old age security, CPP, pension, and then a whole lot of interest. And we're going to get down to total income, $77,743. That number is very close to the one that I start thinking about clawbacks, losing age amounts, losing all kinds of things. So in my head, I'm going, I need to be careful here. So $77,743, what can we deduct against it? Well, nothing. Clawback, I'm going to go down, I'm going to go, what is my clawback? 79. So I just made it under the wire. What will happen to him next year if he has lots more interest income? So maybe he put a whole bunch more money in savings account. Next year he's really close to the clawback. I want to have a conversation with him about that. But this year, no clawback. And then when we get to the age amount, if you weren't sure about the age amount, we're going to do the same thing. And we're going to see how close is he. He's awfully close to the top amount for losing his age amount. But if you do the calculation, you're going to see he just gets a little bit of it. So $1,885.45, he does still qualify for the age amount, but he's getting pretty close to the income where he wouldn't. Okay? I'm going to go back to the case for just a minute, and I want to show you on his tax slips some of the things that he has. So pension we can't really deal with. He doesn't want to draw less pension. CPP OAS he is still entitled to. He wants to get that. If he's entitled to it, there's no reason to delay it further. But you're going to look at his T5s. He has a Bank of Montreal interest of $5,481 and a TD interest of $2,116. He probably has savings accounts. So basically bank accounts where he has a large amount of money and it's just sitting there earning interest. What advice might you give him where he could take some of that interest and take it off the tax return? What could he do with the money in those savings accounts? Marisa, put him in a TFSA. If he can get that money into a registered account or into a TFSA, it would take it off his income. And right off the bat this year, we'd be reducing his income by over $7,000, $7,500. That's going to bring him quite a bit down, and he'll have more room before we're going to hit losing the age amount, before we're going to hit the clawback. So you want to look at what you're doing for this year, but you also want to go, can I give my client advice that might help them out for next year? Okay, so we've done the age amount. He's not going to have to claw back OAS this year. He is definitely going to have to pay installments for next year. Let him know his installments are probably going to be pretty close to the tax that he owes this year, which is about $16,000. So he paid $14,500 last year. He'll probably have to pay about $2,000 more in installments. He'll get a statement from the CRA telling him how much to pay. All right, now if you did the whole return and you want the answer, even with the installment payments, he still owes $1,931. Will there be a penalty for him for paying less than he needed to? No, because he paid what they asked him to. He paid the installments that were required last year, so there won't be a penalty. But if he had used a different method, if he'd used the current method or he'd used the prior method, and he owed this year, there would have been a penalty. So for this client, we definitely want him doing installment method. We want the government to calculate it, and as long as he pays what they said on time, he won't have to worry about any interest there. But his installment payments are going to go up next year because last year he needed to pay $14,500. This year, he needed to pay more. So this year, it was higher. So about $16,700 would be my guess. Just an estimate. All right, that is the Chapter 11 review problems. Okay, we're going to take a short break. We're going to come back. We're going to do the Chapter 12 review problems and go on from there. So just take a 5-minute break and come back at 10:20. All right. Welcome back from break. Give me a check mark. Let me know if you're back. We're going to jump into the Chapter 12 review problems, which were also difficult. So I want to make sure as many of you are here for that as possible. Okay, and let's jump into the first one that we have for Chapter 12. So I'm going to jump to the end here. We're getting into more difficult things, so we're not necessarily doing the full tax return, but we are doing the bits and pieces, and then the rest of the tax return you've had lots of practice on. If you want more practice, finish the tax returns. And like I said, if you're not sure if you got the same answer that I got, send me your work, and I'll take a look at it for you. So this is one of the most difficult ones in the book. It's Anil and Sri Kumaran. They have 2 children. They have Varsha and Ravi. Neither children had income. Neither the children is infirm or disabled. Okay. Anil was unemployed in the early part of the year, and then he got a job, so we have a T4 and a T4E for him. Sri works as a technician for Bell Canada. She received money in Canada Child Benefit, and she also received a dividend from Bell Canada. And then late May, she contributed $500 to her RSP, and in early July, she withdrew all the money that was in her RSP, everything that was in there, so there's now $0 in her RSP account, to buy a home buyer plan. What is the problem? So when she did this, you have a receipt for $500, you have a home buyer plan withdrawal, you've asked her, when did you put the money in? She said, I put it in July. When did she take the money out? She's going to tell you, or when did you put it in late May? When did she take it out? She took it out in early July. The problem is it's 90 days. It's before the 90 days. What happens to the $500? Can we put the $500 on the Schedule 7? Can she get a deduction for it? No. So if you are doing this return, you need to make sure her Schedule 7 does not have a $500 receipt on it anywhere. Okay? She's not going to get the deduction for it. What will happen at the end of the day? How much will she have to pay back into her home buyer plan? She took $14,600 out. How much does she have to put back in? $14,600, all of it. She will eventually have to repay all of it. So she's not getting a deduction on the $500 now. She's going to have to pay it back when she withdraws the money from the RSP. What will happen? That $500 will be included in the withdrawal. She'll have to pay tax on it a second time. So the penalty for her is that she's got a $500 amount that she's made taxable twice, because she's going to pay tax on it now. She doesn't get a deduction now. She's going to have to pay it back, and when she takes it out in the end, she's going to pay tax on it again. She's already done it. There's nothing we can do to fix it. We just have to make sure it's reflected on the tax return correctly. So I'm going to show you the Schedule 7 for that, and I'm going to do that first because I want this really, really clear so that you know what it looks like. So I'm going to go into Kumaran, and I'm going to go into Sri's return. I'm going to show you her Schedule 7, and you're going to notice she has a $500 RSP receipt, but there is nothing on the first page because, if you're not sure, it says do not include on lines 2 and 3 all or part of the contributions you made less than 90 days before you withdrew it. So we cannot put the $500 on line 2 or line 3. It has to not be there. That was the only RSP receipt she put in for the whole year, so she's going to have no RSP contributions in this year, even though there's a receipt for it. Okay, so total contributions is 0, repayments is 0, amount deducted is 0. She does not get a deduction this year. And then we do need Part E, the withdrawal, and she will withdraw the full amount, $14,600. And fortunately, they did move into the house, so there's no issues there. She doesn't have to repay it now. That's what the Schedule 7 would look like. If you missed that, go back and refresh your rules on how many days they have to be in there. So that's the first tricky thing. Then we have some child care. Okay. Before you even do the return, we're going to take a look. Anil has $16,000 of income plus some employment income, which will count as earned income, in this case, 7,103. Sri has $73,500 worth of income. Who will be claiming the child care on their return? Anil. He is the only one who can. If it was any year other than 2020 or 2021, he would be limited to 2/3 of his working income, his employment income. For 2021, it's going to be 2/3 of all of his income because EI counts. Okay, so I'm going to go into Anil's return now, and I'm going to show you a child care expenses receipt filled in. So we have 2 children. We have their birthdays. We have receipts for each of them, and we have the neighbor's name and social insurance number. The social insurance number is important because they don't have to accept the expenses if you don't have it there. $5,000 of it was paid for child care. The portion that was for the younger child was only $3,000. So a child 6 or younger, we're going to write that portion down here. Then we need the basic limit for child care expenses. They have 1 child 6 and under, 1 child over, and nobody has a disability or an infirmity. So the maximum child care they can claim will be $13,000. They actually paid $5,000, so they can't claim more than that. And then we have to see what his earned income was. Because it's 2021, his earned income will be $23,103. 2/3 of that is 15, so he can claim all of the child care this year. He's going to have an allowable deduction of $5,000. Okay. If I give him a deduction of $5,000, what does it do to his income? Well, his income is $16,000 plus $7,103. He's going to get to deduct the registered pension plan, the union dues, and the child care, and a little bit of enhanced CPP. That's going to bring his income down to $17,350. Will Sri get any spousal amounts for him? Will she have a personal credit for spousal amount? What do you think? Nope, his income is too high. He would have to have income under $13,808 because nobody's disabled or infirm. That's the number you have to watch out for. So because his income has to be under $13,808, she's not going to get that. So for Anil, because they had a question in here, what personal credits will they claim? Anil can claim his own basic amount, and that's the only personal credit he's going to get. Personal credits are the ones that this portion of Part B up to line 81 is personal credits. And if you look at Sri and you look at hers, you're going to find again, her personal credits, just the basic amount. So each of them gets a basic credit, and that's it for personal amounts. Okay. Does she have to report the dividends? She received dividends? Yes, good. They're going to go in two places. They're going to go on the income line. And what is the other place that we want to see something related to dividends? We want to look for the dividend tax credit. Where is the dividend tax credit? Line 40425. So don't forget that. The income is going to go on. The credit also has to go on. Excuse me. Okay. Does she have to report the Canada Child Benefit? Nope, not taxable, not reportable. Okay, we've seen the Schedule 7. If they are first-time home buyers, which they are, we know that they are because otherwise they're not eligible to take the money out on the first-time home buyer plan. What other credit can we give? They didn't own a home before, now they do. We can give them the home buyer amount. Who can claim the home buyer amount? Either one, or they can split it. Would you recommend splitting it? Probably not, if only because it's more paperwork for us. There's two people who could be audited for that instead of one. And also, Anil doesn't have very much income. He doesn't really need big credits, but Sri does. So for convenience sake, I would give the full $5,000 to Sri, which is what I did. But it's important to know you have a choice. You could split it if you wanted to. Can't claim more than $5,000, but you can share between the two of them in any combination you want to. Okay, we've talked about the child care. Anil is the lower income earner. He's the only one who can claim it. There are no Part C exceptions in this family at the moment. Okay, and then the last question. During the year, Anil and Sri bought a new house, so they had moving expenses. What are the circumstances that would make it possible for them to claim moving expenses? What would have to happen for them to be able to claim moving expenses? If they change jobs and move 40 kilometers closer. Good. And then the one that you might forget about if they were moving for a disabled person. In this case, there isn't a disabled family member, but don't forget that that is an exception as well. All right, very good. That is a difficult one. So if you didn't get that one right, try it again. I'm now going to give you the answers. So if you did do the whole return, Sri gets a refund of $1,441.20. And Anil gets a refund of $1,558.49. So they're both getting refunds. It makes sense for them to both get refunds, but you want to warn 3, about how RSPs work, because maybe she's not going to get in a home buyer plan until this one is paid back and they don't live in a home for a while, but she might want a lifelong learning plan at some point in the future, or maybe Anil is going to want to go back to school, so make sure they understand if they do it again, 90 days it has to stay in, so have that conversation with them. Okay. Let's do the next one. Oh, I should show you Anil's as well. So, no, I did. Anil is 1558849. 3 is 144120. If you're not sure, you didn't get those answers, send me yours and I will take a look at them for you. All right, so moving on to the next one. Alan and Lynn, they separated. Okay, so this is a tricky one, but is a really good opportunity to make sure you're understanding how dependent credits and spousal amounts, spousal support, child amounts, elder dependent, how they all interact with each other. Okay, so they're the parents of 2 children. They have Amy and Earl. Amy has income, Earl does not. Neither child has a disability. They both lived with Lynn throughout the year, but for 2 months they were with Alan. And they have a written agreement requiring support payments, spousal and child support, and Lynn has sole custody of the children. All of that information is going to need to be factored in multiple times because we're going to be looking at different lines on the return. So as we go through this, I want you to keep the lines separate. Okay. Now, Lynn had no income prior to separation. After separation, she got a job. And Lynn did receive Canada Child Benefit payments for the year. She's the only one who received them. She was probably getting them while they were married. And now that they're separated, she has sole custody, so she's going to continue to be the only person who gets them. Okay. While Lynn was working, her mother cared for the children at no charge, so Lynn will not have child care. But for the months when they were with Alan, he had to pay a babysitter so that he could work. So as we go through these questions, I want you to remember all of that. The first one, can he deduct the child care expenses he paid? Under the definition of child care, is he a supporting parent? Yes, he is. Is he paying child care to a person who is eligible to get a deduction for? It is a person not related to him, so yes. Okay. And did he need to do it so that he could work? Yes. So for all of those reasons, he can claim child care expenses for those months. If you weren't sure on that, you may be mixing up dependent claims like elder dependent and child care. So don't mix them up. Every line has its own rules. He is a supporting parent for child care. Even though he doesn't have custody in law, she has sole custody. He had custody. In fact, he was a supporting parent for the children for 2 months. And they're his children. So yes, he can claim child care. Okay. Now, due to the separation agreement, Alan is required to make support payments. Is he allowed to claim personal amounts for Lynn and personal amounts for the children? It's the year of separation. So if you weren't clear on it, I want you to remember there's always an exception. In the year of separation, you can claim personal amounts. You can't claim both. So he's going to have to choose if he wants to claim spousal amount or support. But even though he was paying spousal support in the year of separation, he could choose to claim the spousal amount. And in the year of separation, if he had the children with him, he could claim elder dependent, even though he's paying support, but just in the year of separation. So that's a little detail that people tend to get mixed up on because we get it stuck in our head. If you're paying support, you don't get the credit. And you're right. If you're paying support, you don't get to claim the credit, except in the year of separation when you do. Okay, so we're going to leave those on the table as possible things. We have a pool of things to choose from. We might be able to pick a spousal amount for Lynn. We might be able to pick an elder dependent for one or the other of the children. We might be able to pick a spousal support deduction. They're all still available to us. We're going to have to decide what to do out of all the possibilities. Okay. So what personal amounts, if any, can he claim for Lynn? he could claim the spousal amount. If he wants to claim the spousal amount, what will it be? So remember, in the year of separation, prior to the separation, she had no income. After the separation, she had income. What will the possible spousal amount be if he wants to claim a spousal amount? $13,808. It's his tax bracket minus 0 because it's the income she had prior to separation. So if he wants the spousal amount, he can claim $13,808. Good. What personal amounts can Lynn claim for the children? If she wants to claim the children on her return, can she? And how would she do it? Think of the personal amounts section. What options does she have? Eligible dependent? Yep. And Marie says she can't claim support, but that's fine. She's not paying support, so she doesn't have a support claim to make anyway. But you're right. Okay. So she can claim eligible dependent for either child. She has a choice. She can pick Earl, or she can pick, what was the other daughter's name? Amy. She can pick Earl or Amy. Which child does she like more? If she had a choice between Earl and Amy, which one would she pick? The one with no income, which in this case is Earl. So Earl is the better child for the purpose of eligible dependent. She has to pick between them which one she wants. Okay. Can Alan claim any amount for the children? If he wanted to, could he claim an amount for his children? He is paying support, but it is the year of separation. In the year of separation, yes. He could pick either, but, and Brittany, you have the right idea, if he knows that Lynn is going to be claiming Earl, which she is, the only child he has left is Amy. In which case, the amount would be $13,808 minus Amy's income. So now we have to decide which would he rather claim, the spousal amount or eligible dependent for Amy. And if you had a choice, which would you pick? Spousal amount for Lynn or eligible dependent for Amy? You can't do both. Which one is better? The spousal amount is better because Lynn had no income before separation. So for this year, he could pick either, but it's better to pick spousal. We're going to keep that in the back of our minds. We have one more thing to talk about, which is the separation agreement. Between Alan and Lynn, it states that $550 is child support and $200 is spousal support. He paid from the months of May through December. So in this case, he has a choice between claiming a spousal deduction or a spousal amount, spousal support deduction or a spousal amount. Would you recommend that he do the deduction or the spousal amount? Without even knowing his tax bracket, I can give you an answer. What is the maximum deduction he's going to get? Right, so it's $200 for spousal support for the months May through December. What is the value of the maximum deduction? It's 8 months times $200. What do we get? $1,600. Good. So the most he can get is a deduction for $1,600, but he's not going to get the full value of it. Oh, we have a few people who might not be sending to all participants. So if you're sending private messages, try and check. Make sure you say send to all participants because I'm not seeing them right now. So all participants is what you want. Then I can see your answers. Okay, so 1,600 is the most, but I'm going to get a deduction, which is a percentage of that. My alternative is 13,808, which is a credit, which is worth 15%. What is 15% of 13,808? $2,071.20. That is already bigger than the full deduction for this year. So because it's already bigger than the full deduction, I know it's worth more. I can't get the full 1,600. I'm going to get a percentage of the 1,600. So do I want a part of 1,600 or all of 2,000? I'd rather have all of 2,000. It is better for him in this case to claim the spousal amount and not the spousal deduction. Okay? So just because deductions are generally good, we need to know how big they are. In this case, the spousal amount is worth more. So we're going to give him the spousal amount. Good. Now, how much should Lynn report on the following lines? So the reporting line, what is the total support she received during the year? 8 months times 750, 6,000. Good. How much of that is taxable for her? 1,600. Does it matter if Alan doesn't claim the deduction? Does him not claiming the deduction make it not taxable for her? No, no difference. She still has to report it as taxable income even if he doesn't claim the deduction. Okay. So can he deduct the support payments he made? Yes, he can deduct 600 if he wants to, but it's not a good idea because the spousal amount is worth more. So now you can see we looked on the table and we saw there's a possible elder dependent claim, there's a possible spousal amount, there's a possible support deduction. This year, those are his choices. Elder dependent turned out to be not worthwhile because we know Lynn is going to claim the better one. That leaves us with spousal deduction, spousal support. Between those, he has to pick one. He's going to pick spousal amount this year. Next year, what options will he have? So next year, will he have an elder dependent amount possible? No, because next year he's paying support and it's not the year separation. So next year, no choice there. Next year, can he claim a spousal amount? No, he doesn't have a spouse next year and it's not the year separation. So what is his only option for next year? Next year, the only thing he can do is claim spousal support payments. So he will do that next year. Okay, so the year of separation, things get a little bit fuzzier and we have to make decisions. Don't rule things out too early. So look at all the possibilities and then you have to look at real life and go, who is going to do what and what is better for my client today? All right, what effect does the separation have on Canada Child Benefit and GST? And I'm going to add in climate action incentive. In this case, we need to know who has custody. Who has custody in this case? If they file an RC66, what will the document say? Lynn. So because Lynn has custody and Alan does not have custody, Lynn will get the Canada Child Benefit. Lynn will get the GST. The children will be on her GST credit and the children will be on her climate action incentive. And Alan will just have a claim for himself. And Marisa, it's not because of lower income. So that's important to know. It doesn't matter what the income is. It matters what custody is. But you're right, the lower her income is, the more she's going to get. So whatever the Canada Child Benefit will be based on her income alone, not based on joint income because now they're separated. Okay? Excellent. Good. That was oh, that's what you bet. I wasn't 100% sure, so as I was talking it through, I said, oh, I think that was where we're going. So I apologize if I interpreted it wrong. And Helene, if there's nothing in writing, it isn't necessarily joint custody. It becomes a question of who is actually doing the work. So again, if you think about, I had that client, I think I talked about it in this class as well. I had a client where her husband left, and then he kept saying that they were married because he thought he would get something out of that, and she should have been filing it separated, but she didn't know she was supposed to file separated. In their scenario, he left the house, He didn't pay support, and he didn't do anything to look after his kids for years and years. There was nothing in writing. But definitely it wasn't joint custody. It was sole custody for the purpose of the tax return, and therefore the purpose of anything having to do with Canada Child Benefit. If there's nothing in writing, we look at what the case in fact is instead of the case in law. So case in law is what's in writing. Case in fact is what's actually happening. Now, if he went to court and said, I want joint custody, he could make a claim for that, and that's outside of the tax return. All right, one more. Schmidt, Arnold Schmidt. Arnold lives with his two sons. He works as a steel rigger. He was out of work in between jobs. He suffered a back injury as workers' compensation. He had a busy year. He had a lot going on. Okay, so during the year, he received Canada Child Benefits for his son, William, and his older son, James. He put the money into bank accounts at the Bank of Nova Scotia in the children's names, separate accounts just for Canada Child Benefit, not mixed with anything else. That's important, okay? Both boys have part-time jobs. James earned $11,100. William earned $1,600. Okay, Arnold owns Bell Canada shares. They pay dividends. He also put money into his RSP, and he has a receipt, and he has room for it, so that's useful. Okay, he also repaid an Employment and Social Development Canada training allowance. He had received a training allowance that he had to repay, and we have a statement of Crown debts repaid for that. We have a T4, and another T4, and a T4E, and workers' comp. And then we have a T5 for Bell Canada, and a T5 for Bank of Nova Scotia in James's name, and a T5 in trust for William. Does it matter whose name is on these T5s? In real life, if his name was on it because he was the adult who opened it, would it make a difference? Nope. In those cases, it doesn't matter. Money still belongs to the children because it's solely from Canada Child Benefit and it wasn't mixed. Who does the interest belong to? So in a scenario where the money came straight from Canada Child Benefits and was not mixed with other income, who claims the interest? The kids do. In all other scenarios, we would have to be thinking about attribution rules. So don't forget that attribution rules apply. If he just gifted money to his children and put money in a bank account for them because he's a nice person, you need to think about the attribution rules. But in this case, the attribution rules do not apply because it's from Canada Child Benefit. So if you weren't clear on that, go back and review your attribution rules. All right. Does Arnold have to report workers' comp? I'm going to do this really fast. Yes, he does on two lines. It goes on the tax return as income and comes off to calculate taxable income because it's not taxable. EI, yes, goes on as EI income. And remember, it's usually not taxed enough, so probably he's going to owe from that. CCB, no, doesn't have to go on the tax return. Interest from the Bank of Nova Scotia will not go on his return. It will go on his children's returns if they're filing returns. They might not need to, but if they are, it's going to go on their returns. Can he claim a personal amount for any child? He has two dependent children. Can he claim eligible dependent? Yes, he can. Who should he pick? Which child does he like better? William or James? We like William better because he makes less money. So we're going to pick William. Okay, pick the one with the lowest income. What can he do with the repayment of the training allowance? It's a deduction. Put it on the deduction line. In this case, it goes on line 23200. If you weren't sure, that's where it goes. How much RSP deduction he claim? He has a receipt. He has room. He can claim all of it if he wants to. We need to do a Schedule 7. So very, very quickly, I'm going to show you his. And we're going to go into Arnold Schmidt. I'm going to show you his income. We have income from employment, income from EI, some dividend income that's his. Don't forget the dividend tax credit. And workers' comp that goes on the return into total income. For deductions, we're going to do a Schedule 7. The Schedule 7 is going to be very straightforward. He'll get a $2,000 deduction there. We have some union dues. We have some enhanced CPP, and we have the repayment. So the repayment is going to go here on 23200. That gives us net income of 43,916. Then we're going to take off the workers' comp. That gives us taxable income of 39,316. We're going to do a Schedule 5. Schedule 5 is going to be for William. So William's Schedule 5 is going to look like this. First and last name, William Schmidt. Relationship, still living in the home. Year of birth, relationship is son. No infirmity for him, so there's no caregiver amount for William, but we have some income. William's income, don't forget, has to include both his income from work and the interest income. So if you missed that, you would have gotten a different answer. Make sure you add the interest to his income because it's all his income. That gives us an elder dependent amount of $11,840.75. Okay, the Schedule 7, just a quick refresher on the Schedule 7. He put $2,000 in. He's not making any repayments. He has $18,000 of room. That's more room than we need. We're going to give him the full deduction this year, and he'll have no carry forward for next year. When we go into this portion of the return, he's going to get a personal amount and an elder dependent amount minus William's income, CPP, EI, Canada employment amount, and that's it. No medical expenses for them, but if there were medical expenses, make sure you're double checking James's age to determine if he's a minor or over 18, because if he's 18 or older, his medical expenses that his dad is paying for would be on line 33199. Okay, and if we get to the end of the return, nice big refund, $4,274.64. Most of that is from the elder dependent amount. So make sure that he's prepared for a possible request for info or more information. Again, if he's been essentially a single dad for a long time, there won't be an issue, but they can always ask again if they want to. Okay, I'm going to spend the next little bit, and I have a video that I want to show you. So you're going to take a break from thinking, okay, and we're going to jump in and do this. So I'm going to stop sharing my screen briefly. Everything's going to jump around. Okay, so for this, I'm going to share a quick video. This is about working at H&R Block. So if you're planning or interested in working for H&R Block, there will be information in here that's interesting for you. If you weren't, but you hadn't thought about it, I do recommend watching it anyway. Take a look. You might get some ideas of what things are available to you. This is not necessarily just working in tax, but working in other supporting roles as well. And as always, if you have any questions about what it's like, what the hiring practices are, anything related to this, please ask questions. I will answer your questions. Nancy, I'm sure, will have her own opinions as well, and we're here to help with that. So I'm going to run this, and then hopefully we'll just make sure that it's working. So. All right, so I hope that worked for everyone. I know the visual may have been a little, depending on your screen and how it was set up, it may not have been super clear. So if you do have questions about anything that wasn't covered, or just generally any questions for working H&R Block, please let us know. And for those of you who are concerned, you're taking the course, you're doing your best, but you're not sure you're going to get that 80%, but you want it to work for H&R Block, we absolutely can still use really good people who have an interest in tax and are enjoyable and like working with other people. We definitely also have other roles in the company that are as critical as tax pro. I would say most tax pros will say their front desk people are even more important than the other tax pros in the office. If we have a really good person at our front desk managing the flow of clients, getting the information from them, handling our bookings, all of the things that they do, it makes our job much easier. And it is a way to get involved in tax and see what's happening with tax, even if you haven't quite made it up to 80% this year. It is a way to kind of get your foot in the door and find out if this is the type of work that you'd be interested in. So many different opportunities will be open. You should be getting an email, as they said in the video, sometime around November 2nd. If you don't get one, please let me know, because I can make sure that it gets sent out to you. So if you're interested at all and you don't get that email, I would say by the end of this week, send me an email and I'll make sure that we follow up with anyone who's interested. Okay, we're going to take a short break here, and then we're going to do all of Chapter 13. And Anne-Marie, so you haven't prepared a resume for 30 years. Don't worry too much about it. Put down your life experience. You've probably had all kinds of interesting life experiences that make you organized and detail-oriented and enjoy working with people. Oh, Brittany, you're having audio problems. All right, so I'll type something in the chat window for you. We're going to take a quick break here. We're going to come back at 11:16, and then we're going to jump into the last chapter. All right, we are back from break. We are jumping in. I'm going to share my screen. Pull up my windows as I usually do. I'm going to pull up the slides. So a lot of this course I've been telling you we're going to talk about students later. It's later. This is the last big different type of income, a different type of credits we have to handle on the return. And there are lots and lots of special rules. So the first thing that I want you to do is I want you to remember, like everything on the return, every line has its own rules. You really need to be careful to separate out when we're talking about income for a student versus when we're talking about credits for a student. There is a lot of overlap and then one or two differences, and it becomes very easy to mix the differences together. So we're going to start with income and the rules for income and what qualifies for income, and then we're going to jump over and we're going to talk about credits, and you need to keep the two ideas separate. So if it's income, the student is getting money. If it's a credit, the student is paying money. Keep those two issues separate in your head. So what type of income do students have? Well, there are different kinds. The most common that we see all the time are scholarships, fellowships, bursaries, and achievement prizes. These are items of money that you are gifted either based on the work you have done in your academic program or money that is given to you from a program to help you to continue to study. And so it'll fall under both categories. Almost all of this income is reported on a single box in a T4A. So you'll have a T4A slip with a box 105, but it doesn't necessarily tell you how to put it on the tax return, because that will be determined based on the student who's sitting in front of you and which program they're in. So what you need to know is the taxable portion will be reported on line 13010, and the exempt portion will not go on the return. So the exempt portion doesn't show up anywhere. To find out what the taxable portion is, you need to know about the student and you need to know about the program. So a qualifying student in a qualifying program will have tax-exempt income from scholarships, fellowships, bursaries, and prizes. The first type of income, elementary or secondary school. So again, if you're new to Canada or you're not used to this terminology, that means people who are in grade school or high school, but not people who are in university or college programs. So everyone up to the time they get a high school degree If they get a scholarship, it is tax exempt. Okay? So most of the time we're talking about potential taxable student income from scholarships for students who are in university or college programs or other training programs. And I'm going to talk about the training programs briefly. But the broad strokes rule is everyone is exempt for $500 if they are a qualified student or if they're in a qualified program. Okay? And then if you're not a qualifying student, that's all you get. And then if you're in a part-time program, you're entitled to the $500 exempt portion plus your tuition fees and the cost of your program-related materials. Program-related materials might be textbooks, it might be lab fees, it's all the things you need to do your program, and you have to have receipts. So in that portion, the part that is exempt is just the cost of the program plus your fees. And if you're full-time, it's 100% exempt. This is usually not important because most of the time, if you have a part-time student, the scholarship is less than the cost of the program. So most part-time students will get a small scholarship for an expensive amount of tuition, but not all the time. I have had clients who have a nice big scholarship and a small amount of tuition and a small amount of books. And in that case, we have to remember part-time students are different. And you can't tell from the tax slip whether they're a part-time student scholarship or a full-time student scholarship. You have to find out what program they're in. So in this section, I'm going to refer you to the textbook because the textbook is excellent. So if I go into the textbook and the chapter on students and we look at student income, you're going to find more information here of how it gets handled. And I hope you've read this. If you haven't read it, you're going to need to go read it now. So a qualifying student is someone who's enrolled in a qualifying program as a full-time student or a designated institution in a specified educational program that requires them to spend not less than 12 hours in the month on courses in the program. So they have to be in class at least 12 hours in a month. Okay, and then if it's a program that isn't post-secondary, if it's at a designated institution, that's university, college, or other post-secondary education institution, they have to be 16 or older. So if you have a genius child who is 15 and they're going to college, their scholarship may not qualify as being tax exempt, okay, depending on the other rules, okay? So they have to be at least 16 or they have to be enrolled in the program to improve their skills in an occupation, so they can be in a trade. That will qualify. And then there are some things about what happens if you're on the border. So if you have a straightforward scenario, they're in university, you don't have to ask any questions. If you have a complicated situation, they're not in a university program, they're in a different type of training program, in that case, you're going to have to go to your book and you're going to have to see, what do I do with the scholarship income? How much of it is taxable? Okay. Some extra things here about postdoctorate fellowships. When you finish all your degrees and you have a doctorate, you might still be in school. My brother-in-law is one of those people. He has been doing a postdoctorate work at a university for years and years and years. If it's a research component, if you are still connected to the school, but you already have your degree, you have the highest degree you're going to get in your field, and you're still at the school because you're doing research, that will be treated as research income. And so the same rules that we know for research grants will apply. Okay. If it's not for research, if it's for your own training and your own studies, and you're still at that school and you're still studying, but you're not contributing to research as the main component of what you're doing, in that case, you'd be eligible for some exempt status. So $500 of that will be exempt. But if it's research, then it's going to be, you don't usually get the $500 exemption, but you will get to deduct your costs in the same way you deduct your costs for research. So like I said, normally straightforward, not a problem. We look at our students, they're full-time or they're part-time, everything's easy. If you have a messy scenario, then you're going to have to go to the book and look it up. Okay? And then the last one is artist projects. You might be a person who is developing your artistic endeavors and you get a scholarship, bursary, or prize in order to produce a literary, dramatic, musical, or artistic work. In that case, you get to deduct the $500 plus all your expenses connected to making the art that you made. Okay, that's actually really new. There was an artist who got this who went to court and said, I think the $500 should be exempt in addition to my costs. And the CRA said no. And the taxpayer said yes. And they went to court and the court said the taxpayer's right. So we now have a case that has clarified that rule for us. So now we know artist grants, they get the $500 exemption plus the cost of making the art. Okay. So what is a qualifying educational program? It has to last 3 consecutive weeks, 3 weeks in a row. It has to be minimum of 10 hours of instruction or work per week. And it has to be at a designated educational institution. And that 10 hours a week doesn't include study time. It includes homework time, so the time to do the assignments, but not study time. Okay? And then a specified educational program, which is for training, has to be at least 3 consecutive weeks. And it would be a qualifying educational if the hours per week was met. And it has to be in order to have lectures, practical training, and lab work. So this course falls under the definition of a specified educational program, and you are categorized as qualified students. So if any of you received a scholarship to come to do this program, that scholarship might be tax exempt either as a full-time or a part-time student. I can tell you for this course it would be part-time. Okay? And they will give you an example in here. So let's test that knowledge a little bit. And I'm going to do a little sharing here. It will allow everybody to annotate. And I'm going to add some information. If Kim is a full-time student, how much will Kim report on line 13010, given that Kim had a scholarship of $10,000, tuition for the course is $5,000, and they paid $700 for textbook and lab materials? Put a check mark in the column that you think is the right amount. So I'm asking you, how much is taxable income that will be reported on line 13010? Let's get some volunteers. Okay, a handful of people are saying 0. If you said 0, you are correct. You're going to have a tax slip with a T4A with a set amount of money. You're going to identify that they're a full-time student. We'll talk about that a little bit more when we talk about receipts for tuition. But you're going to find out that they're a full-time student, and you're going to say tax exempt. Great. Let's do another one. So this time, I'm going to tell you that Kim is a postdoctoral fellow, no research component. So they are in a qualifying institution, but they are not a qualified student. In that case, $10,000 scholarship, same tax slip, how much will they have to report on line 13010? Okay, got a couple of people saying 9,500. I agree with you. 9,500. The rest of it they can't deduct. It's all taxable except the $500 exempt portion. Good, that's a trickier one. We don't see them all the time, but we do see them. So if you have someone who already has a PhD and they're taking more courses, I'm going to have to dig into what they're going to school for a little bit more. Good, let's try another one. I'm going to do, they are a part-time student. Okay, if we have a part-time student, how much will be taxable? Be careful. How much can they deduct from their income? You can deduct tuition, you can deduct books, and the base exempt amount, which is $500. So the correct answer for this one is $3,800. Everybody forgets the extra $500 because it's not written down on the screen. But remember, $500 is exempt plus tuition plus books. So I'm going to take 10,000, I'm going to subtract 500, and then I'm going to subtract the tuition, and then I'm going to subtract the books. So 3,800 is the correct answer for this one. I'm going to do one more. Okay, and I'm going to warn you in advance, this is one of my favorite types of questions. This is going to be a trick question. What if it's not actually a scholarship? What if Kim is a research student, go over here, with a research grant? In that case, how much will be reported on line 13010? Okay. If you think the answer is 0, you are correct, because they will not have taxable income for that line number. What line number will their income be reported on that is the taxable portion? Where do research grants go on the tax return? On line 10400. So we're going to then find out how much of it we can deduct on line 10400, and that's where the income is going to go. And Helene, why wouldn't a full-time student get the same deductions as part-time? A full-time student gets more. Because you're in school the whole year, it's expected that you can't work. So they assume that you need the scholarship. And because you need the scholarship, they make it not taxable. Okay? So the important thing to remember when you get a T4A with a box 105 is you have to look at the student sitting in front of you and ask what they got the money for and what they're doing with it. So did you get the money? Is it connected to your schooling? If it's connected to your schooling, what are you using it for? Are you a full-time student? Are you a part-time student? Is this a research grant? Is this a postdoctoral fellowship? What is the money for? You have to dig into it a little bit. Once you dig into it, you determine how much goes on the tax return. Again, 9 times out of 10, when we're dealing with scholarship incomes, we're talking about university college students or people in training programs who have full-time programs and scholarships. Most of the time that's true. Sometimes they're part-time, but the scholarship is smaller than their costs, in which case it ends up all being deductible. But we have to ask about it, because sometimes it's part-time and it's not entirely tax deductible, and we have to include some taxable income on the return. Okay? And then the unusual ones, research postdoctoral fellows, those are rare. And if you get one of those, just look it up. I still look them up in the book when I have them. I had a similar scenario for a taxpayer just last year when I was doing them, and I did not trust my own memory to get it right. I just went straight to the textbook and said, all right, how do I categorize this income, and what are my expenses? So the easy ones, full-time, part-time, make sure you know those. The other ones, be prepared to look them up. All right, that's not the only income you can get as a student. You could also get money from an RESP. Remember, we talked in the registered plans section, investment plans. People can put money into an RESP, and then when you're a student, you can take money out. So RESP contributions, we already know, are not taxable. There's a maximum you can put in. Once you open an RESP, you can only continue to put money into it for the next 31 years. After that, you can no longer contribute. And at the end of 35 years, all the money has to come out. One way or the other, the money has to get used. Okay, they put that limit so that you can't just continue funding RESPs as a way of putting money and letting it grow in an unregistered investment, because when it grows, you're not going to pay tax on it until you take it out. Okay, so it is limited to what you can do. There are matching grants and bonds. There's information in the book about that. We're going to go very briefly through that. Okay, What happens when you take it out? The beneficiary is going to receive payments that comes in two pieces. Part of it will be the original contributions, and because those were already taxed, because you didn't get a deduction when you put the money in, that portion is tax-free. And then the portion that's the growth, the income from the investments within the plan, the growth portion is taxable. Okay? If it goes to a student who is in school, the taxable portion is called an education assistance payment. It's reported on a T4A slip in a box 42, and that income belongs to the student. So the student will get a tax slip. Only the taxable portion will show up on it. It'll be a box 42 of a T4A slip, and it is the student's income. It is taxable income, and it goes on line 13000. Okay? There is a problem if the person doesn't go to school. So if you are the parent who set up an RESP and then your child says, never mind, I don't want to go to school, I'm going to become an artist and travel the world and not study in anything formal, and then I'm going to open my own business and I could really use that money. If you take the money out when they are not in school, in that case, you don't get the same thing, which was an education assistance payment. You get an AIP, which is an accumulated income payment. In that case, the money goes back on the return of the person who put the money in. So whoever put the money in your RSP is going to get a box 40 on a T4A slip, and it becomes their income. So they're going to have to pay tax on the taxable portion instead of the student because they're not a student. And there's an additional 20% tax for all of that money, unless the person who put the money in the RSP originally has room. Now it says transfer, but that's not a good choice of word, unless there's room to purchase an RSP. Because you can't do this as a transfer. Remember, transfer doesn't use up your RSP room. They have to use that money to buy an RSP, and they have to have room for it. If they do, they just get the income on their return. If they don't, they get the income on the return plus an additional 20% tax on top of that. And that's the penalty for putting money into an RSP and getting the benefit of it for years and years and years, and then taking it out and not using it for what it was supposed to be used for. Now, for those of you who remember when we did registered plans and when we did disability and medical, what option do you have if the reason that your child doesn't end up going to school is because they have a disability that means they can't? If you have a child with a disability, what can you do with the money in the RESP that would protect you from this? Instead of taking it out, what can you do? Transfer it to what? So, Bo, you're on the right idea, but what am I going to put the money in? What type of fund do we have for disabled people? You can transfer it to an RDSP. So this is one of the other main benefits of an RDSP. Is if you have an RESP that can't be used, you put the money in when they were babies. You know, they were born and you said, first thing I'm going to do is open up an RESP. You can do that. You put the money in when they're children, then something happens, you find out they have a disability, they're not going to be able to use it for school. You can take it and put it in an RDSP instead without having it come into your income and without having the penalty. So that is a benefit of an RDSP. For everybody else, if you take it out and they haven't used it to go to school, it's going to be your income. The person who put it in, it's going to be your income. And if you don't have RSP room to buy an RSP for that amount on your own return, you're also going to have a 20% penalty. Okay. There is a Canada Education Savings Grant. For more information, I'm going to ask you to read your textbook. But generally speaking, there is a matching program for low-income families. Low-income families, you put money in RESP, the government will put some money in for you. There's a maximum grant for your life of $7,200, but you can also get an enhanced Canada Education Savings Grant if you have very low income. And that is to make it possible for very low income families to still be able to put some money aside for their children's education when they won't be able to pay out of pocket for it later. You get room, the unused room, if you don't use it, you can use in a subsequent year. So if you can't put money in this year, you might be able to put money in next year and get the grant next year instead. Okay? We don't handle this other than to educate our clients. So if you have a client who is low income and they have a child and they're concerned about how they're going to pay for that child's education when they grow up, you can tell them, are you aware of the Canada Education Savings Grant? Go find a financial advisor and they give you some more advice about what happens if you open an RESP and what happens with matching grants. And then there's also a Canada Learning Bond, which is an additional, it's basically a loan from the government to buy an RESP. So they will give you money, which you can then take and use to buy an RESP, and they'll continue to help, and then they'll do the matching on top of that. Now, if you get a Canada Learning Bond, you actually have to use it for the RESP. You can't take the money and spend it on something else, because that would not be what it's for. So if you take the Canada Learning Bond, you must purchase an RESP for that amount of money by the time the child turns 21. Again, lots more details in the book. I'm not going to spend a lot of time on it. The income you need to know. So you're going to have a T4A with a box 42. That is income for the student. You have a T4A with a box 40. That's going to be income for the person who put the money in. And then warn people if they have a child who's not going to school and they have an RESP, let them know they have to start figuring out what they're going to do with that money. It will have to come out eventually. And when it comes out eventually, if they're not a student, there will be penalties. They might need to save some RSP room for it to avoid those penalties. So tax planning at the other end of things we can still do for our clients. Okay, so we've talked so far about where students get money from: scholarships, RESPs. They also work. We know how to deal with working income. Students can also get student loans. So to qualify for student loans, they have to get them under the Canada Student Loans Act or similar provincial laws. To count for a credit on the return, it has to come from one of those programs. It can't be a loan from a bank or a student line of credit. It can't be a loan from an employer. Those don't count. You can get those, but you're not going to get a tax credit for it. But if you're using the provincial or the federal plans, you can get a student loan. You usually don't pay anything until after you graduate, and then after you graduate, I believe a year later, you have to start paying it back. The interest portion you get a tax credit for, only the portion that's interest, because the principal you don't get. The person who had the student loan is the person who puts it on their return. So that's important to know, because if you are just graduated, you may not have any income, and your parents might be paying your student loans for you. The parents do not get the interest, just the students do. Okay, and you can save it. So just like donations, you can save it for the next 5 years. Why might you choose not to claim your student loan interest the year you start paying your student loans? What is a reason to not claim it in that year? You might not need it. So a lot of students right after they graduate are very low income and they don't need non-refundable credits. They can save them. This one's very easy. The students get a receipt. They're in the Canada Student Loan Program. They have an online portal. Ask them to log into their online portal. Every single year it will have a statement of this is the tax portion you can claim on your return. It's a very easy statement to find. If they haven't claimed it in previous years and now they need it, you can go back 5 years, get the receipts, and pull them together. Okay? Goes on line 31900. If it's older than 5 years, they lose it. But anything in the last 5 years, we can put on for this year. And then the most common one, the tuition tax credit. This is the one I want to make sure we finish today. So tuition fees, you can get a tax credit for the tuition fees you pay. Generally speaking, most programs are going to issue a slip called a T2202. If you have a T2202 slip, we'll see what one looks like. You take the figures from the slip, and that tells you what to do. Okay? Just because you have a slip doesn't mean you are qualified to claim them. We're going to talk about that. But if you have a slip and you are qualified to claim them, the amount that you can claim is based on the slip. There are a few exceptions where you can claim tuition even though you don't have a T2202. Most commonly, we see that from licensing exam fees for professional statuses. So lawyers have to pass the bar exams. The bar exam fee counts as a tuition tax credit. Doctors have to pass their Royal College exams. They may have other licensing exams. Pharmacists may have licensing exams. Those fees, they don't issue you a T2202 for them. The examination fee will count, but it has to be a profession or trade in Canada. So any profession or trade, if it's not on a T2202, if you have a receipt, you can claim it as tuition if they meet the other tests. Everyone else, no. So there's lots of other exams you might take. If we charged you an examination fee for this course, well, it would be included in our T2202. But if we had a course like this one, but it didn't issue a T2202, and there was just an examination at the end, that would not count. Okay? But this is one place where you might find your accountant's fees and things like that. Okay? You're going to claim the fees for tuition in the year that it's incurred, which is the year you were a student, not the year it was paid. And that reflects the reality that most education in Canada goes across the tax year. So most students in Canada go to school from September until April or September until June. And for that reason, they will have a bill owing in September, but they won't necessarily pay it until the scholarship money comes in, maybe in January or February. So it doesn't matter when the money came in, it matters when they were a student. So it's going to be allocated to the months that they were studying. Okay? And if you want a bigger list of what is or isn't included, I want you to refer to the textbook. Again, qualified student, qualified program is different for the tuition tax credit than it is for determining scholarship income. Keep the two ideas separate. Okay? Generally speaking, fees have to be $100 or more for one school. So if you take multiple courses at one school and each of the fees is a small amount, $40 here, $40 there, if you have enough at the one school altogether in the year, that will count. But if you do a $40 credit over here and a $40 course in a different school and a $50 course in a different school, that will not count. So then they will not get tuition. And Helene, is there a list of eligible licensing fees? There is not, but the definition is profession or trade. So if you can find out, is this considered a profession or trade in Canada, those will count. And remember, your clients likely to get audited, so make sure the receipt makes it clear that it is the exam fee and not additional fees. So when you get one of those, go back to your textbook and see what is allowed and what is exempt. So travel fees might not count, conference fees might not count, other student fees might not count, but the examination fee will. So if you're dealing with a receipt other than a T2202, you want to use your textbook to make sure that it is eligible. Okay, so fees would be nothing that involves transit, board and lodging, student association fees, those do not count. Again, most of the time we have a T2202, the university or the college has decided what your fees are. Similarly for this course, you're going to get a T2202 for this course. We have determined which portion of it is eligible for the tuition fee. That's what you're going to put on your return. Okay. Fees can be claimed for institutions in Canada if it is post-secondary, taken at a university, college, or other institution, or courses that develop or improve your occupational skills, like this one. If it's those, it has to be taken in an institution certified. We are a certified institution in this course, or at a post-secondary education in Canada, but not at a post-secondary level. You can take university courses without getting it towards a degree. That would count, okay? But in that case, you have to be 16 or older to get the tuition credit. Tuition fees over $100 I've talked about, so multiple courses in one institution, as long as it's $100, all of it will count. Separate fees under $100, throw those receipts in the garbage, you can't use them. Tuition fees do not count if they are paid by someone else. So if you're not paying the fees and someone else is paying the fees, you are not a qualified student for the purpose of the tuition credit. You might still get a receipt. You might get a T2202. You cannot claim a tuition credit if you didn't pay for it. So what counts as not paying for it? If it's a federal or provincial job training program, because you get tax-free money to pay for your course, you can't also claim the tax credit for paying for your course. That makes sense. If your employer pays for you and they don't include it as a taxable benefit in your income, so if they're not taxing you on the money, they're just paying for your education, you don't get a tuition credit. You will get a receipt. You cannot use it. Okay? I want you to remember that. And if it's an employer of your parent and they're not being taxed on it, in that case as well, you're not paying for it, you don't get the tuition credit. There is one exception which can get fuzzy, so I want to make sure, because we see this in Manitoba, if the education is being paid by a band or council, so if you have a student who is identifying as First Nations and they are living on reserve, their band or council might pay for their education for them. In that specific circumstance, they do still qualify for the tuition credit. So there is an exception in that rule. It has to do with how the money is considered to be owned. So essentially, that counts as their income, as if they are paying for it themselves. So that exception is one that people get a little bit mixed up on. So if it is money from a band council, in that case, it is still treated as tuition for the student. But other federal or provincial job training programs, no. Okay. There is a similar credit if you go to an institution outside Canada, but different rules. Outside Canada, they have to be a university or you don't get it. They have to be full-time or you don't get it. They have to take enough courses to be full-time. And this is the fun one, they have to pass them. So I only know about this because in my family, my sister did her degree in the US. She had 1 year where she went to probably more parties and less class than she should have been going to. She did not pass enough courses to qualify as a full-time student for that year. So she only qualified as a part-time student for that year. 2 things happened. 1, she did not get to claim her tuition on her Canadian tax return. And 2, she had to leave the country because her visa required her to be a full-time student. So she actually had to come back to Canada and reapply to finish her degree and be a little bit more careful the next year. So institutions outside Canada, they have to be full-time students. They have to be 3 weeks or more. In that case, you don't have to worry about the $100 rule, but let me tell you, if you're paying foreign student fees to a university anywhere in the world, you're paying more than $100. So that's a moot point. You have to get a different form for tuition fees paid to an institution outside Canada. We're going to talk about that. I want to show you in your facts and figures book a really handy chart. If you haven't seen this chart before, this is my go-to reference guide when I have to deal with complicated tuition things. So if you go to your facts and figures and your checklist, I think it's number 48, what qualifies as tuition fees? You're going to have 2 types, schools in Canada, schools outside Canada. The type of school is here, the type of course is here, the documentation you need is here, whether or not there's a minimum fee is here, what happens for non-resident students, which is outside of this course, but I run into those all the time, is here, and what happens if fees are paid by someone other than the student. So all of these rules are summarized in one really handy chart that you can refer to for your own studying and your own use when you're doing tax returns. I think Facts and Figures is my new favorite book for this course. Since we've pulled it out, it has a lot of really useful sort of handy reference guides. All right. If you are going to claim tuition fees, you need receipts. So if it is a receipt other than a T2202, then you have to make sure that it says what it's for, and again, go through the list and make sure it's eligible. If it's a T22, it means it's a Canadian institution or a flying school or club in Canada. If it's a university outside Canada, you need a TL11A. The university has to fill it out. T2202s happen automatically. Every school in Canada issues them to all of their students. How will you get a TL11A? Let's say they went to school in the States and you want to get tuition for that school. Will the school issue a TL11A automatically? No. Definitely not. So the student has to bring it to their school financial department. They will have to convert it to Canadian funds. I'll tell you, most places don't convert it to Canadian. So if they don't, they have to identify what currency they're putting it in. They have to determine what counts. So when I send my students who have foreign student fees, I give them the page from my textbook that says what is included and what isn't included to make life easy for the school. And then they have to stamp it with their official school stamp. If you have that, then you can put the tuition on the return. Do not put the tuition on the return without that document. If they're a commuter to the U.S., they live here, but they go to school across the border, there's a TL11C. Most of those schools do that for their students as long as they know that they're commuters. But again, you may need to give this university a little bit more help to get the documents. And then deemed residence is a TL11D. That's outside the scope of this course. We're not going to talk about that. But TL11As, you have to know how to get. T2202s, you're going to see all the time. How to claim it, you enter them on line 32000, Schedule 11, or if it's outside Canada, on 32001. Then you have to say, is the student eligible for disability or mental or physical impairment? That's important because if you have a disabled student and they're part-time, for the purpose of tuition tax credit and anything connected to tuition tax credit, they are treated as if they are full-time. Because their disability may mean that they cannot go to school full-time, but they would otherwise be going to full school time if not for the disability. In that case, you're going to tick box 32005, and everything that says part-time will be treated as full-time. So if they're a full-time student because of their disability, their scholarship will be for a full-time student. Their tuition will be calculated as a full-time student. Okay? And then any other things like Canada Workers Benefit, anything connected to students, they'll be treated as a full-time student if you tick that box. Then we need the number of months they're part-time and the number of months they're full-time. I'll show you why when we get to the Manitoba schedules. And then any tuition transfers, you can transfer tuition to other people you're going to deal with. This is what the form looks like. You have the university, the name of the student, and then you have how many months and which months they were in school, how many of them were full-time, the total number of full-time, and then part-time. If you have a student who is full-time for 8 months and part-time for 8 months, how many months can you put on your Schedule 11? 12, because you can't go to school for more than 12 months in the year. So you have to be limited to 12 months total. In that case, would you rather have more full-time months or more part-time months? Which is better? Full-time months. So if you have more than one T2202, which you might, you have some students who go to school full-time and then take another course. That's what I did when I took this course. I was doing a full-time master's program, and I took the tax course at H&R Block, which was a part-time course. You're going to total all the full-time months first, see how many part-time months you have left over, but you have to check the dates, because if you weren't in school in the summer, then you weren't in school in the summer, and that's important to remember as well. Okay, so not more than 12. Make sure you don't have overlapping dates. This is where you get the information for tuition that goes on your tuition tax credits. And then there's the back page. If you're going to do a transfer, I cannot stress enough, this back page is critical. You must designate who you're transferring it to, how much you're transferring federally, how much you're transferring provincially, and the student must sign it. These get audited all the time. You should do it at the time. It is the second page of the T2202. Anytime you're doing a transfer, print it out, get the signature, stick it in your file. You are going to be asked for it, and if you don't have it, it will adjust multiple returns, which is not a good idea. All right, we have 3 minutes. I'm going to show you how to do the schedule itself. Okay, so I'm going to go in here, and I'm going to show you your federal tuition first. Anything that you haven't used tuition for, you can carry forward. You're going to get that from your notice of assessment. So any carry forward federal amounts will go on line 1. Tuition fees paid to a Canadian institution will go on line 2. We'll talk about the Canada Training Credit next class, but if you have a Canada Training Credit, you can take a portion of it off here and claim it as a refundable credit instead. Foreign institution, you're going to put on line 8. Add everything together, that's your total tuition available for this year. Find out how much of it you need to use on your return to bring your taxes owing down to 0. You have to use your tuition credits if you need them. You can't save them for the future if you have tax owing. So you have to use up as much as you need in the year. Anything left over is going to go here on line 17. Then you're going to say how many, if you're disabled, you're going to say how many part-time, how many full-time. Then you're going to find out if you want to transfer. If you want to transfer to a parent or to a spouse, you can transfer a maximum of $5,000 only from what's from this year. You cannot transfer carried forward amounts You can only transfer new amounts. So we're going to find out how much new amounts you have available and then transfer as much as you can. Choose what you're going to transfer. Everything else will be carried forward to the next year. That's the federal form. The provincial one in Manitoba looks a little bit different. In Manitoba, we have the same number. You're going to have your unused tuition provincial carry forward, which will be calculated differently. So your provincial carry forward amount. And then we're going to do your total contributions for the year on line 2. That comes from your federal schedule. Then we have an education and textbook amount. So this is an old thing that used to be federal. Now for Manitoba, it's just provincial. Not every province has it. This is why we need to know part-time and full-time. Every month you're part-time, you get another $120. Every month you're full-time, you get another $400. So we get a little bit extra because you're full-time or part-time in Manitoba. You're going to add that in, calculate how much you need, use up what you need to use for this year. Anything else can be carried forward. And then again, if you want to, and you didn't need to use it from this year, so we have to see what's left over from our contributions from this year, you can transfer up to $5,000 provincially as well. Okay, we've hit 12 o'clock. I've shown you how to do it. We're going to come back next class and we're going to finish this. But you should have enough now to start working on your assignment. Remember, you have a little bit of extra time. So give it a try, and we'll finish off student income and student credits at the beginning of next class. You're also going to read chapters 14 and 15. They're very short, so we'll be finished by the end of next class as well. And make sure you've done your review problems. Please do them ahead of time for next class because they're not going to make sense if I just give you the answers. Okay, we're going to stop there.